Happy Tuesday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Tuesday, March 19th, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like the analysis supporting these conclusions, as well as what to specifically do about them in your portfolio, you need to be a client of 42 Macro. So, as always, we'll start with today's key macro event, which is the BOJ ends NERP and YCC, but offers dovish forward guidance. And so the nuance there is the BOJ ended the most aggressive monetary easing scheme in modern world history with its first positive policy rate since implementing NERP in 2016, a scrapping of yield curve control, and ending 14 years of purchases of ETFs and REITs, which left the BOJ the single largest owner of Japanese stocks. What the BOJ did not do today is set the stage for a sustained tightening cycle. Governor Ueda stressed that there is still a chance that their inflation goal will not be met, which is why they pledged to keep financial conditions easy. That pledge was supported by their decision to continue buying long-term JGBs as needed, despite scrapping yield curve control. Elsewhere, NVIDIA stock is essentially flat after it unveiled its new Blackwell GPU design at its GTC conference, which is said to be multiple times faster than its current GPUs. Valuation alone is a telltale sign that a lot is priced into the stock, which implies investors looking for exposure to AI must be more clever going forward. In terms of market implications, in our view, the BOJ going out of its way to stress prudence and further policy normalization does limit any damage to the uptrend in global liquidity because it reduces the likelihood of the BOJ catalyzing simultaneous uptrends in fixed income and currency volatility, key countercyclical drivers of global liquidity. Lastly, investors looking for a broad stock market exposure should anticipate a continued broadening out of participation in the equity bull market. Transitioning to our 42 macro dashboard, as always, we'll start with trading range signals from our friends over at Longbow, getting an overbought signal here in crude oil, so be aware of that. Also getting an overbought signal here in the S&P 500. Let's see, we keep moving here. Getting an oversold signal here in the Russell 2000. Getting an overbought signal in the Shanghai Composite. What else here? Let's see, keep moving here. Lots of signals here. Same thing as yesterday. Overbought signals in the 10-year, 2-year, and 10-year tips, 10-year, 2-year nominal treasury yield, and the 10-year tips yield. And then lastly, oversold signal here in Bitcoin and likely in our friend Ethereum here as well. So be aware of that in terms of the tactical trading range signals. These are short-term market timing signals for anyone, sort of trading the portfolio, any sort of high turnover strategy. Definitely be using things like your trading ranges to longbow trading ranges to help you time your entry and exit points in financial markets, or time your dollar cost averaging. You want to be dollar cost averaging slow when an asset is overbought. You want to speed up your dollar cost averaging when assets are oversold. So again, dynamic dollar cost averaging is better for your long-term returns than just dollar cost averaging as a sort of automaton or someone not being thoughtful. So as always, we'll transition and wrap up with a question from our community. Questions about buying dips. So reads, hi Skipper, how would you incorporate buying dips and risk on regimes, Goldilocks and inflation, while following KISS and positions are full allocation? Would this be only when bottom-up signals reduce a position, then later increase, or is this at investor discretion based on the top-down regime and volatility adjusted momentum signals? So for those investors that are implementing our systematic KISS portfolio construction process, KISS will tell you when to buy the dip and in what. And so obviously that the top-down and bottom-up risk management overlays will determine the target allocation and the actual exposure to each position respectively. And so anytime a position is not at its maximum exposure, then KISS may send a signal vis-a-vis the top-down risk management overlay, which is dictated by the market regime, or the bottom-up risk management overlay, which is driven by the volatility adjusted momentum signal for that particular asset. It could send a signal to increase exposure, increase the actual exposure for that particular exposure. So SPY, ag, and Bitcoin are our stock exposures. We have the many investors around the world implementing customized versions of KISS, based on the research that we provide. So we definitely recommend that if SPY, ag, and Bitcoin aren't great for you, you can consult our discretionary risk management overlay for ideas and all the signals that you need to implement those overlays to spread out that allocation or to change into different exposures. So that's if you are following KISS. KISS will send out systematic signals, again, based on the evolution of those overlays to buy the dip when it's appropriate to buy the dip. If you're not following KISS, then ignore everything I just said, and you're going to be using different aspects of a 42 macro research to give you indication on buying dips. So if you want to buy the dip in a particular factor exposure in our probable range process, our goal in our crowding model, our probable range process and our crowding model are the best drivers of that. If you want to think about buying the dip from a broad asset allocation perspective, then our global macro risk matrix, our positioning model, and our dispersion model are the best tools for that particular strategy. And then lastly, macro weather model as well, if you want to think about it from a factor from a particular asset class perspective as well. So we'll wrap it up there. Darius Dale presenting our macro minute for Tuesday, March 19th, 2024. Everyone have a wonderful day out there. Best of luck. We'll catch you back here tomorrow. Cheers.